Hello, my name is Warren Poe, and I'm a CI Brightworth partner and wealth advisor in our dental practice area. I'm excited to welcome you to the inaugural episode of the CI Brightworth Quarterly Investment Commentary. In these quarterly webcasts, we hope to deliver timely and useful information and our thoughts on the markets and the economy in general. Today, I'm joined by Don Wilson, who is our Chief Investment Officer and leads our investment committee here at CI Brightworth. In addition to Don, I'm also joined by John Darby, who's a portfolio manager on Don's team and also serves on our investment committee. I'm going to turn it over to Don and John for some prepared comments, and then we'll wrap up today's webcast with a few commonly asked questions that we're hearing from clients. Don, take it away.
Thanks, Warren. It has been an eventful first 12 weeks of the year. Lennon one time said, "There are decades where nothing happens, and there are weeks where decades happen." That certainly seems to fit these first 12 weeks as a lot has happened. And we're going to talk about that today. We're going to talk about what's happened in the markets. We'll talk about, from an investment perspective, Russia's invasion of Ukraine. We'll talk about the Fed and inflation and bonds. We'll also talk about an inverted yield curve and what that may mean for the economy ahead. And finally, we're going to answer some questions that we've heard and been hearing from clients. So a lot to cover. And John, start us off. Talk to us about what's been taking place in the markets this quarter.
All right. Well, as you can see here, a lot of negative returns for the first quarter. Let's start with stocks. Earlier in the quarter, stocks were actually down double digits across the board, but they've since rallied back to some pretty modest losses. But it's often the case, and especially this quarter, that the broad index returns don't quite give you the full picture. Take, for example, the energy sector. So think oil and gas. The energy sector was actually up over 40% just this quarter. No other sector was up more than 5%, and most were actually down. Interestingly enough, energy is still the worst performing sector over the last 10 years, and over the last 8 calendar years, it's either been the very best or the very worst performing sector, nothing in between. So definitely a bumpy ride, but really good to have in the portfolios in a year like this. On the opposite side of the spectrum, some of the more high-flying, fast-growing technology stocks, especially the ones that benefited from COVID and were dubbed work-from-home stocks, have fallen pretty hard. So take Zoom, DocuSign, Peloton, Teladoc, stocks like that, down a pretty good bit. And interestingly enough, all of those stocks have underperformed the broad market since the start of the pandemic. I say that mostly just to show how unpredictable markets are. Now, when it comes to portfolios, those are a tiny fraction of a percent in the portfolios, if they're even in there at all. So no material impact, but just to kind of illustrate some of the dispersion, there was a lot going on under the hood. So let's move on to bonds. As you can see, it was a really rough quarter for bonds. And to put that return into context, since the beginning of the aggregate bond index in 1976, that was actually the third worst return for any quarter that we've had. So very challenging environment. What happened? Well, that return was almost entirely a function of rising interest rates. Interest rates went up pretty quickly, a short amount of time, and so bond prices fell. Now, we're still not seeing very many defaults at all, so bond issuers are still making interest payments. That negative return is just a function of rising rates. So we'll unpack this a little bit more later, but for now, I'll just say that we think it's pretty unlikely that bond returns will continue on this trajectory, and the outlook for bonds is much better now than it was a few months ago. So with that said, I'll turn it back to you, Don, and tell us what's going on in the world.
Thank you, John. So we're going to talk now about Russia's invasion of Ukraine. And first off, we just want to say all of our hearts are with the people in and around Ukraine who are going through just a really, really terrible situation. So from an investment perspective, war is always unpredictable. And this one has been no different. It has been full of surprises. It was a surprise that Russia invaded Ukraine, mounted a full-scale invasion. It was surprising how poorly Russia's military has performed, and surprising how courageously the people of Ukraine have defended their country. It's been surprising at how this has caused the West to unite caused NATO to really be reawakened. And the level of economic warfare that the West has engaged in against Russia has been unprecedented. We've never seen anything like it. The level of sanctions, the freezing of assets of Russia's by the West, including Russia's central bank, unprecedented. And I think finally, something else that's been surprising has been how well the stock market has done during this time period.
You're right. I think it would have been really hard to predict how the stock market would react to the invasion of Ukraine. The day of the invasion, U.S. stocks were actually up over 1%, and then the next day they were up over 2%. Pretty big move, despite the fact that it was very clear it was going to be serious at that point. Meanwhile, international stocks were roughly flat, and so I think part of the reason for this, we'll show a slide here to illustrate. Unfortunately, armed conflicts are all too common, but they generally don't have that big of an impact on the stock market, especially long term. And I think part of the reason for that, we'll take a specific stock as an example. So take Apple, biggest company in the world. Well, as a result of this, Apple had to shut down some stores in Russia, so they're not selling iPhones in Russia right now, but that just makes up a tiny portion of their revenue. So Apple is still doing just fine. They're making as much as they ever have. And if you look at other companies, it's similar. So take Microsoft, Google, Amazon, earnings basically unaffected by what's going on. And that's what tends to drive stock prices over the long run. So, stock market still doing pretty well since the invasion. So Don, if the market's not concerned, what are some of the longer term implications we should be thinking about here?
Yeah, I think three things that are some long-term implications that we're thinking about. I'm sure there's others that will come out, but first I would say Russia and Ukraine are not big parts of the global economy. They have small economies. However, they are big exporters of energy, so oil and natural gas from Russia, big exporters of agricultural products, so things like wheat, as well as industrial metals. And so we are seeing prices of all of these be affected. We do expect there to be disruption to these. And so as a result, I think that inflation is probably going to be a little bit higher than it would have been otherwise and may last a little bit longer had this not been taking place. A second implication that I would point to, for decades, the economy has been in a mode of globalization. Companies have sought to produce their products and their goods around the world in whatever is the cheapest location that they can do that. And so we have very intricate supply chains that oftentimes span multiple countries and even continents. Because of COVID and now because of this war in Russia and Ukraine, we've seen a lot of issues with that. A lot of companies that have been negatively affected because one part in one plant that goes into the end product they can't get, and they're not able to produce the whole product. So for example, in Germany, BMW has had to shut down their plant to produce the automobiles and the vehicles because they get a wiring harness from Ukraine. It's about a few $100 part, and so their vehicles that are $50,000, $60,000, $70,000 plus, they had to shut down the whole plant for this one part. So I think you're going to see reshoring. You're going to see companies bringing jobs and manufacturing back to the U.S. I think that will long term be a good thing for the U.S. economy. But that's a second implication that we see from this. A third one is, I mentioned before what happened as far as the U.S. and the West freezing the assets of Russia's central bank. That's going to have a ripple effect, I expect, as it relates to how central banks and how foreign countries think about their reserves. I think they're going to be rethinking those and thinking about what has happened with Russia and how do they now position themselves against something like that potentially. So a lot of things, I'm sure there's others, but a lot of things that we'll be thinking about and how this will impact the economy and the markets in the years ahead. So with that, John, talk about what's happening with inflation and the Fed and bonds. What do we have going on there?
Sure. Well, I know I don't need to explain inflation to anyone. If you've bought pretty much anything recently, you've seen it, you've felt it. So inflation much higher than it's been for the last few decades. And it's really not all that surprising given the enormous amount of monetary and fiscal stimulus as a response to the pandemic. But the question is, where does it go from here? Are we going to continue to see higher inflation? Is it going to cool down? Inflation is as hard as anything to predict, but in my opinion, I think inflation is going to cool down. I think over the next year or two, it'll be a lot lower. Maybe not as low as it's been, sub 2% over most of the past decade, but maybe somewhere closer to the 3 or 4% range. Obviously, the Federal Reserve is increasing interest rates to try to cool off inflation. So far, they've only raised short-term interest rates by 0.25% one time, although they have communicated they plan to do so 6 more times. However, the Fed has, they've made plans before that didn't exactly pan out. So we'll see what happens. Things can change in a hurry. But for now, the plan is to continue to raise interest rates. I think the economy is in a good place to handle higher interest rates. Consumer balance sheets are in good shape. Household net worths are at all-time highs. Debt is low. Good job market. Spending is good. And then on the corporate side, corporations, sales are at all-time highs, margins and earnings are great. So the economy should be in a pretty good place to handle higher interest rates. So that leads us to the next question, which is, what about bonds? It seems like if rates are just going to continue to increase, then bonds are going to continue to fall. So a lot of clients are asking, why should I own bonds? Should I still own bonds? Short answer is yes. We think that investors should still own bonds. They're still a key component of a diversified portfolio. And here's a few reasons why. So one, we'll pull up a slide here to show that for a long time, economists have been forecasting higher interest rates. So that dotted blue line there is economists' forecast of future interest rates. That solid blue line is the yield on a 10-year Treasury bond, which is a good proxy for what interest rates actually are. So you can see economists are always forecasting increased rates, but most of the time they've been wrong. And maybe rates will continue to rise, but even if they do, it's probably likely that it's going to be at a much more moderate pace. So I don't know that higher interest rates are a guarantee at this point. Another thing that's encouraging with bonds is because of the structure, there's a math component and the range of outcomes is bound. And so if bond issuers continue to make interest payments, the prices are going to converge back to par, and investors will receive principal back along with the income. So that's encouraging. And then as prices fall, yields increase. So future returns look better and you have a yield there to help cushion any further price drops if rates continue to rise. So overall, it's been a tough stretch for bonds, but higher interest rates actually set us up much better for future returns. And especially for investors who are drawing income off their portfolios, for retirees in particular, it's a good thing to have higher interest rates and have bonds pay a higher yield. So not all bad. Higher interest rates also benefit banks, insurance companies, pension funds, and then savers as well. A lot of us have savings accounts, money market funds, CDs, and they've been paying virtually nothing for quite a while. But higher interest rates will allow us to get a meaningful amount of interest there. So much better position for bonds, even though it's been a rough stretch. We're more optimistic moving forward. And on a related note, we've been hearing about the inverted yield curve. So Don, can you explain to us what that means, and is that setting us up for a recession?
So the idea of an inverted yield curve, and could that mean that a recession is coming, has been in the news recently. Some people may be asking, what is a yield curve and what's it mean for it to be inverted? So let's talk about that first. A yield curve, and we're going to show this on this graph, is just a picture. And on the horizontal axis is the maturity, how long until the bond matures. The vertical axis is the yield. And so in a normal environment, what you're going to see is short-term bonds pay lower yields, longer-term bonds pay higher yields. So the curve is kind of up and to the right. Now, in some time periods, which is fairly unusual, you'll have what's called an inverted yield curve. typically what happens is when the Fed is raising short-term rates, the short-term part of the curve starts to be higher. But if investors don't expect that to last, if they don't think that these higher rates are going to continue, the longer end of the curve, longer maturity, may continue to be lower, and that's what gives you the inverted yield curve. And so why would that be an indication of a potential recession? Well, it oftentimes happens because investors are saying the Fed has raised rates too high, and that may slow the economy and lead to this recession. Historically, it's been a pretty good indicator. However, the amount of time between when the yield curve inverts and a recession is really variable. Sometimes it can be about 6 months, sometimes it's a couple of years away. I think another thing to think about too is that in periods when there's been higher inflation, really you saw the yield curve invert, meaning short-term rates were much higher than long-term rates before a recession hit. So we're not seeing that yet. Right now the 2-year, a shorter-term bond, is close to the same yield as a 10-year bond, but we would probably expect to see it much higher given the higher inflation before we would think of that as being a concern. Likewise, oftentimes you see the 3-month Treasury yield also be higher, and that's not the case. And two, when we think about some of the other indicators of economic health for the economy, things like the Conference Board's leading economic indicators. It's at a high point. It just rose in February, and so that is giving no signal at this point of any concern of recession. As you mentioned earlier, John, consumers are in a good place, companies are doing well, and so it's something for us to watch, but at this point we're not concerned about the yield curve, even if it were to invert a bit at this point. Another thing to keep in mind is that historically, the time between when the yield curve inverts and the recession starts has been a good time to be invested in stocks. Stocks have typically done well during that time period. And so, as we would see right now, this is not something that we're concerned about, something we'll watch. But for now, the economy still looks like it's in a good place, and we are not concerned about the yield curve and its positioning at this point. So a lot of stuff that has taken place in the first 12 weeks of 2022. Warren, I think, has some questions that we've gotten from some of our clients. And so, Warren, you want to ask us some of those?
Thank you, guys. I thought we'd ask a couple questions that us as advisors are hearing from our clients as we do our calls. One thing that's on everyone's mind is what investments in the past have performed well in inflationary environments?
Good question, Warren. When we think about what investments do well during periods of inflation, I think when we think about the stocks, companies that have pricing power, who are able to pass along the increased production prices to consumers, those typically benefit or do well. Companies that have more current kind of dividends and income oftentimes are better than companies that are sort of the high flyers that are dependent upon growth that's many, many years out in the future, because those earnings that are many years in the future are now going to be less in an inflationary environment. From a bond standpoint, bonds that have a floating rate that may increase automatically with rising rates typically do well. Shorter duration bonds as well. And then we also think about real assets. So think about real estate or other commodities. Those are other areas that do well typically during an inflationary environment.
If I'm a retired client, what am I supposed to do right now? I look and my bonds are down, my stocks are down. It makes me feel a little uneasy. Any suggestions?
Yeah, I hear that, Warren, and we know that this has been a challenging quarter for bonds, and it's unusual for us to see both bonds and stocks down in the same quarter. I think one of the things to zoom out just a little further and think about is just how strong stocks and bonds have done. And when we look back over 12 months and 3 years and 5 years, it's been a really, really good period. And so having one quarter that is down, we think is obviously we'd rather not have any down quarters, but that's just part of investing. And so as we think about this, we would look at it and say, okay, a 60-40 generic portfolio, so just a hypothetical 60% S&P 500, 40% Barclays Aggregate Bond Index, back to about the level it was in October of last year. But again, we think about how strongly these portfolios have done over and just the broad bond and stock markets over the last 1 and 3 and 5 years. And I think it's important to keep that in mind and keep that in perspective.
One question I'm hearing from my clients is, what if I have a liquidity event and I'm sitting on cash? Cash is obviously being impacted by inflation. Bonds are down, stocks are down. What's the recommendation there?
Yeah, another good question, Warren. There's two main approaches. So one is to go ahead and invest it all at once, and the other is to do it more slowly over time. We call that dollar cost averaging. And statistically, markets go up a lot more than they go down, and so statistically the best option is to go ahead and invest it all at once. However, I know a lot of people are not super comfortable with that, and so it can actually be better, psychologically it can be better to spread it out over time. I think the important thing with that, if you're going to do it that way, make sure to be systematic. So set a schedule. You can invest it monthly, quarterly, over 1 year, 2 year, a lot of different ways to do it. But stay systematic, take the emotion out of it, and then get invested soon. Either approach can be good. And I think we want to make sure we stay away from trying to time the market. And regardless of what happens over the next week, month, quarter, I think in the next 5, 10, 15 years, you'll be glad that you got invested.
Thank you, Don and John, for your time today and your investment insights. We hope everyone enjoyed this new offering from our team. If you have any further questions or concerns about the changing investment landscape, please reach out to us. Until next quarter, thank you.